Namaste everyone. A very good evening. Beyond Classroom Season 17, and this is the session 3 in this series. And the whole series is about alternative investing, portfolio management, and portfolio structuring. So today we will be introducing the speakers. Deepak will be doing the same, our speaker. And today we have a very special session and about the very special way portfolio management is done through a portfolio management scheme. And also I have requested our speaker to talk about basket portfolio also at the end of the session. So these two things will be taken care today, and along with that we will be opening for the questions and answer. So we'll request all of you to listen and then keep your questions ready so that whenever we get an opportunity we can do that. So Ashit C. Mehta was there at our conference also, and now we have their team and the investment team also. So I'll request Mr. Deepak to introduce our speaker today, and we will take it forward from there. My colleague Nishant and Tushar are also there on this call. So any help required in between, they can be of great help to each one of us. Over to you, Deepak.
Thank you, Kanak sir. Thanks very much. And hello and welcome everyone for today's event. I am Deepak Pokana, Principal Officer of PMS from Ashit C. Mehta. And so today the presentation would be done by, the speaker would be Mr. Ashwini Shami. He's the co-founder of Omniscience Capital and he's EVP with them. Omniscience Capital is the brain or the organization which has designed this scientific investing framework. He will talk in more detail about that. Ashwini leads the advisory and investment research at Omniscience Capital. He brings in more than 15 years of experience in the financial services industry. Earlier to this, he was working with Goldman Sachs as equity research analyst, and his expertise lies in developing investment strategies to harvest returns by focusing on intrinsic business value and identifying pockets of investments of mispricing. Yeah, he has done a BTech and MTech from IIT Bombay and has earned his MBA from IIM Lucknow as well as Toulouse Business School, France. So I think so that's quite for all of them. Please handing over to Ashwini. Ashwini, you can carry on.
Yeah, hi. Very good evening, and it's great to be here interacting with all of you. I'll just try and share my presentation first. Let me try doing that. Yeah, so it's visible. Yeah, okay, perfect. So we are to talk about PMS baskets and everything, but I see all these licenses and structures as different ways of bringing out the investment offerings to our clients. But at the heart of it, at the core, objective is to first understand what is the investment philosophy, because whether it is a mutual fund scheme or a PMS or a AIF or a basket portfolio, end of the day, what delivers performance for investors is basically what is the framework, how you're creating. Everyone is creating a portfolio. It's a set of stocks, it's a set of curated portfolio, but the reasoning behind that or the rationale behind that is what makes all the difference. Now with we have so many manifestations of products. We started with mutual fund, but now we have so many evolved product structures, right? So my presentation is can be split into two parts broadly. One is the concept of Bharat Amrit Kal, like how and why it is important to look these next 25 years in a different way, and what kind of investment opportunities are there for us, and why should we allocating significantly to equities at this point in time. And while we do that, but because the broader opportunity is great, the broader opportunity is very, very promising, there is a way to do it, which we have designed, on which our PMS and baskets are based, is something we call a scientific investing framework. And we'll try and get a bit detailed into how the framework works. And with the help of the framework, how we identify the hidden investment themes or hidden investment, kind of what we call them growth vectors, is something that we want, all of you to, kind of take away from this presentation. And this is one personal experience that when we give, when we convey this kind of message to the client, and they feel really excited about, and they want to really take exposure to something which otherwise, if we just bucket it under equities, then they feel very restricted in terms of, okay, this is large cap, mid cap, small cap, what I'm getting into. Because even in small cap space, in mid cap space, in large cap space, there could be amazing opportunities which you see from a different lens. Then there is a whole perception is different. So that is what our effort is. Obviously, we are talking to all professional people here. So, but still, it is important to do the disclaimers. So I would still reiterate that investments in securities is risky, and everyone or anyone who is taking exposure should read all related documents carefully, and based on your risk appetite, your risk profile, your financial goals only, then one should take any exposure to equity investments. So let's move on. These are the vision for the way we see India evolving in the next 25 years is that it has a potential to be something like a $50 trillion economy. Obviously, there was a lot of debate whether we have become a 4 trillion, or before that there was a debate, we are going to be 5 trillion when in 25, 26, 27, or by, some fund houses or research guys have said that we will be 10 trillion economy by 2030 or 32 or something. So this is very good, but the true potential that we see is something like a 50 trillion economy, and this is quite massive. Okay, US is something like a 20 trillion, 25 trillion economy. China is maybe let's say 12 trillion economy, and so on. So we are talking about a really, like, we are going to be number 1, 2, 3, anything, but we are going to be very, very big. This is a simple simulation which we have done based on various scenarios, right? So we're very aggressive, optimistic, base case, conservative, or very conservative in all, and these are not very crazy numbers. These are like 8, 9, 10, 11% kind of long-term growth rates that we are talking about. And that also, if you, and we are talking about nominal GDP numbers in USD numbers, right? So it's the real growth is something for India that India has delivered is like 5-6% is something we expect, right? Indian economy is to grow. It has a potential to grow up to 8% on a continuous basis. So that is, and then there is an inflation of, let's say, 4%, 5%. Target range for RBI is 2 to 6%. So even the base case of 4% gives you something like a 5 plus 4 is a 9% kind of a growth rate, right? So even if the base case we assume, this is the kind of something like a 30 to 35 or 40 trillion economy is something we expect us to be in the next 20-25 years in the Amrit Kaal. The reason why it is going to be important, see, we are already number 5th, right? So we are already a very large economy, right? But there is something amiss, right? It's still not a development. What the idea is not to, like, just put out a large number here. The idea is to, kind of estimate that based on these numbers in the next 20-25 years, I have another side here which talks about the GDP per capita or the per capita income, right? On these different aggressive, optimistic base and conservative cases, you'll see that we are somewhere around $15,000 to going up to, like, say, more than 35, 40, $50,000, right? Now, this is the range which basically puts us in a high income economy. Well, earlier used to be called the developed world, developed economy, right? So even in the base case, so the classification is $12,000 today is considered, anything above $12,000 is considered high income. 2,000 to 12,000 is considered medium income, middle income, and less than 2,000 is low income. So we are going to be catapulted into a economy which will be a developed economy or a high income group. And with that, there are a lot of opportunities that come around. So that's the key message, that why this is going to be, because our population growth will be slower, and the base case that everyone is building, right? China is going to slow down, US will grow at 4-5%, and still going to be a very, very extremely large and important economy. But for India, the scale is going to be massive. So that is the background on which that we are investing for the long term. Now, when we do that, these are the three focus areas that we have identified, that one needs to take exposure to, whichever structure or wrapper you are doing. But the end bottom exposure has to be at least on these three fronts. One is obviously the US economy. US economy is the most innovative economy. It's a growth economy. We believe that it's a developed economy, so it will not grow at that rate. But in the last 10 years, there are more than 100 companies which have delivered 20% CAGR. Right? So we believe that because the scale is like that. Right? There are 1,500 companies in the US multi-cap index. So there are a lot of high growth companies as well. So it is imperative that people who aspire to be a global citizen, then they start taking exposure to US economy as well. Second, and very transformative, disruptive, that thing is happening is the AI revolution. So digital transformation is the starting point for that, but the world is moving towards AI, right? And that is something that if you're not taking exposure to the disruptors, then you will be getting disrupted, right? So it's a very, very extremely important that we position our portfolios for the next 10 years and next 20 years, that how the S&P 500 or how the Nifty 500 is going to evolve in the next 10 years and 20 years. And that is where we need to visualize and be. So this is a very, very important part of our investment focus. And finally, the India. So India, I already talked about, is going to be like a 50 trillion or a 30 trillion and extremely large economy with a lot of opportunities, because you will be unlocking a lot of potential with a large chunk of the population becoming, their consumptions patterns, their needs, their demands are going to evolve all in a different way, which is going to generate a lot of opportunities. Plus, the world is changing. In the people moving away from China, and India is giving the alternative for that, and that's where it is extremely important for India domestic story, as well as how the world is evolving around India. So this is the focus area. Now, before I get into the investment philosophy, the scientific investing framework, and then what the kind of growth vectors that we are seeing, what is the framework is throwing at us. Let's just understand the differentiation, right? So everyone's trying to create a portfolio. Everyone's trying to beat the market, justify performance, expenses, and gather AUM. But this is our kind of essence of over going through hundreds of years of investment management history in the US and in India. And what we have realized that most of the market participants chase alpha, they chase X's return. How can I be ahead of the market? And in this quest, we have seen that they end up getting risk. Right? They end up buying companies which brings risk to the portfolio. While what our belief is, and it is little counterintuitive, this high, low risk, high return kind of a scenario. So what we have seen that in a risky asset class like equities, if you focus on safety, right, then the alpha becomes a byproduct. You don't have to really see that, okay, which is the company that's going to deliver alpha for me. You create a portfolio, you reduce the risks that are there in the market. Especially this is for the risky asset class. It's not about if you compare fixed income with equities, then definitely high risk, high return holds, right? Because it's not about that. Once you have decided that you will be in equities, then you don't have to chase returns, right? Because equity returns, we all understand that they are crazy, right? Amazing. They're beating every asset class. Once you have decided to be a part of risky asset class, then you have to focus on safety, and that is where your alpha will come from. This is our belief system, and this is what translates into the investment philosophy. So let me just straight away jump to that. Now, the philosophy or the framework is a two-step process. One step is to, as I talked about safety, is to enhance safety. Right? How one can, being in a risky asset class where the companies can potentially go to zero, where even if you're holding a large cap portfolio, mid cap, small cap, all kinds of companies are exposed to risks, and all the best brand names and all the largest companies, whether they are banks or whatever industry they belong to, they all can go to zero. That's a fact. Now, in that scenario, how do you enhance risk? What we are what we're showing here is, you start with the full market, and then you have to eliminate certain kind of companies which can potentially bring risk to your portfolio. Now, what are these? Again, when we say risk, we don't mean academic risk. It's not about standard deviation or beta or market price fluctuation. It is about at the end level where the money is actually going. When I'm buying a portfolio, the money is actually going into a particular stock, and that's where I have to manage the risks, right? So which companies can go to zero is something that I have to worry about, or reduce, eliminate, or erode my capital, right? So there are three types of risk reduction process, or companies that you have to be wary of. One we call as capital destroyers. Now, these are typically highly leveraged companies, or companies which are making consistent losses, or companies which are weak, poor business models. And that is where they should ideally not be listed, but everyone can, with certain requirements, can go and list a company. So these are not investable. So they are listed companies, but they are not investable. And sooner or later, or majority or some part of these companies are eventually going to go to zero. So if you are not investing in these companies, you are saving that much capital. So this is extremely important to stay away from these companies. The second type of companies where you can lose money is what we call as capital eroders. Now, these are the companies which are actually earning return on their capital less than what is the actual cost of capital for them, right? So they'll do 7-8% kind of ROE, while their actual cost of capital is 12%, 15%, whatever. Now, the longer you stay with these kind of companies, they are eroding slowly, gradually your money. Right? You want to stay away from these companies. This is like a death by 100 cuts. It's not a one shot, but it is over a period. It will, and this company is seemingly grow. Price might also appreciate in some cycles. The top line will also grow. They will be paying taxes and all that, but they are actually eroding shareholders' wealth. So this is the second type of company that we want to stay away from. Now, the third category of risky companies is what we call as capital imploders. Now, fundamentally, these companies are very different from capital destroyer eroders, where they are fundamentally very, very strong. Okay, they are actually so good that they become the darlings of the market. The market loves them, and they take their price so high that from being a good company and a good investment, they have become a good company and a bad investment. And this is where the valuations are not sustainable. And over a period, once the company hits some kind of a roadblock or some kind of a difficult economic condition, its price implodes. And as a shareholder, you end up losing money. So this also, like investing in the best companies or most loved companies and most strongest companies, can also be extremely risky for you to either lose capital or have less than the market returns. So this is also a risk factor. You also have to stay away from such companies. So when you reduce or eliminate or mitigate these kind of companies from your portfolio, what is left is what we call as a capital multiplier portfolio. These are all fundamentally strong companies and are also available at a reasonable valuation. So this is the first step where we are reducing risky companies and focusing on fundamentally stronger companies and which are also available at reasonable discount. The second step now is to enhance your return profile by focusing on growth factors. Now, growth factors which are yet to be identified by Mr. Market. That means that these are the growth vectors which are hidden. These are below the radar, and that is how you are going to get the maximum, right? So if particular growth vector is already identified, everyone is chasing that company, and its P is already at 150, then there is no fun left in that growth vector. You are actually not going to generate any significantly higher return. In fact, you are actually at a risk, right? Like a capital imploder kind of a scenario that I just talked about. So here, what we are looking at is to study the companies like in the screened pool. So you start with top 1,000 companies, you eliminate nearly like 800, 900 companies with all these kind of different risk parameters. And in the last 100 odd companies pool, you see now these are all fundamentally good companies. You could buy all the 100, you will be ahead of the market potentially. But if you can do better, and then you look at the companies which are actually exposed to some kind of a growth, which is outside, which is being created outside of the company, right? So there is some technology transformation, some behavioral changes, or some socio-economic changes that are happening, which is providing some kind of a growth opportunity for this company for a longer term basis. Now that is where I want to focus. And these opportunities do exist, and then you can identify these. Some of these opportunities that we identified in the past, they've started unlocking, but they have not completely unlocked. So this is what I will give you kind of a brief orientation in the next few slides to give you an idea that how can you identify such things, and how can you have supernormal returns from these companies potentially. So this is broadly the framework. Now, how this framework helps us to identify these themes. So let me take a few examples from the current portfolio. Again, these certain growth factors are part of the current portfolio. It's an evolving process. There will be some which become fairly priced or overvalued, and they will be out of the portfolio. And then we will continuously be identifying more and more such growth factors. So one growth factor that we identified, like around 3 years back, was railway infrastructure. So a lot of activity that was happening on the infrastructure building side, and railway infrastructure, it was restricted to some very, very monopolistic companies which are delivering amazing growth in double digits, as high as 20-25% over a 5-year CAGR, and with good margins, good profitability, but yet available at maybe single digit Ps. So that was an amazing opportunity that we identified. Obviously, as I said, there are certain market anomalies that why such thing should happen, or why it remains below the radar or behind, in the blind spot of Mr. Market. One possible or plausible reason was that some of these companies were public sector companies, and people had a view so far that no, they cannot create wealth, and which has changed in the last couple of years. But we were clear, because we were going from a bottom-up approach, very, very fundamentally driven, and we were listening to the company management, their order books, their execution track record, and what they were saying that they are going to do, and what the policy decisions at the government level that were taking. So there are multiple sub-growth vectors that are we are seeing under the railway infrastructure itself. So before I get into this multiple growth vector, let's set the context by looking at how the railway budget has evolved over the last many years. Right? So like 10, 12 years back, we had like a 20,000, 24,000, 26,000 kind of a this is gross budgetary support that comes from the railway, from the center for the railway, and this has gone to 2.4 lakh crore. Right? So this is just the gross budgetary support. The actual investments that happen is significantly higher. Like last year, when the GBS was around 1.4 lakh crore, the actual investments on infrastructure was nearly 3 lakh crores, because the companies raised public money as well, and then there is money that is provided by the financing arm and things like that. This year also we expect this to be 4 lakh crore and more. In this context, let's go back and see that the the TAM for target addressable market for this handful of companies is actually very, very large. The government has said in various communication that they are working on a very, very extensive investment plan, and the number is somewhere around 50 lakh crore. That's what the total investment that railway needs in the next 10 years or by 2030, let's say. And it becomes very easy or clear to understand, like if we are spending around 4 lakh crore in a year in 2023, then definitely 23-24, then definitely that is not a crazy number to kind of visualize, right? And because of that, there are opportunities that are evolving. Now, what is these opportunities? One is on the freight side, right? So the railway earns nearly their total earnings or profit. Three, 1/4 comes from the passenger traffic. The other 3/4 of the revenue comes from the freight. And this is when we are working on a very low percentage of the, like if you take the modal share of the freight market in India, we have only 27-28% coming to railway, while for any developed nation, this is something nearly 60%, and around 20-25% to the roads, and the remaining to the air and the waterways. So railways are on a mission to take this 27% freight market share to 45% by 2030. And there are multiple things that are going to help them to do this. So one is they are building dedicated freight corridors. Now the eastern and the western freight corridor is nearly completion stage, and they are going to give a lot of predictability, a lot of speed to which at which the freight moves. Right now, the average speed for freight through railways is around 25 km per hour, which will be increased to 60 km per hour once a lot of these things are in place. So they are getting better, wagons. They are building the separate network. They have electrified all the network. They are building double stack, wagons or railway lines which can support double wagons, 2-tier, right? So this is one part. We have all heard about Vande Bharat story, that how indigenously we developed that. Now that is another growth factor. So we will have 400 Vande Bharat trains by 2026. Beyond that, this will come as an export opportunity, because our Vande Bharat trains are nearly 60% cheaper than the equivalent train which may be imported. And because of that, it becomes an export opportunity once we have serviced our own network completely. So that's a great opportunity. And then again, this is with very few companies. They have gotten these orders, and they have started, putting up the manufacturing plants and so on. We are working on high-speed networks. We are working on metro networks or rapid transit corridors. We are working on the modernization of our, stations. So they already identified 1,200 stations. The budgets are crazy, right? For this, we will be going and modernizing. So there's there are 50-60,000 network, right, of stations. So all put together, that's where the investment of 50 lakh crore going to be. They will be executed through a handful of companies, and obviously new companies will be listed. New companies will come from private sector and so on. So it has emerged as a sector in its own sense, and it is offering a great opportunity. So still undervalued. A lot of unlocking has happened in companies which are part of this, but still below the intrinsic value. So it's an amazing opportunity that we can look at. On the similar lines, digital transformation is one growth factor that we identified way back in 1780, and that is the time when people were writing off the IT services companies, that they have lost the product leadership, they have missed the bus, and the cost arbitrage model is over. But clearly their digital businesses were growing at 30, 40, 50%, but that was a smaller part. And once that digital business has become a significant part, their overall growth numbers have, and obviously COVID helped in fast forwarding the whole growth scenario. So that 1.0 unlocking has already happened, but then we again got opportunity because of the US inflation scenario and the interest rate going up, and now when the interest rates have peaked nearly with the cuts, and US economy has continued to deliver very, very excellent growth, like 5% growth of GDP. So that rhetoric was more of kind of I would say it was in anticipation of that there will be slowdown, but that slowdown has actually not happened. So the whole market opportunity for IT services companies or companies which are delivering digital transformation in various forms, right? So cloud migration was the main business so far that these companies enjoyed, but then they're working on metaverse, they're working on AI in the form of generative AI engines, they're working on IoT. So every part of technology transformation needs handholding, and which is where these companies come in. They have trained, extremely large uh, population of employees, and they are very, very strongly equipped to continue to deliver on this front. And you are getting some great growth opportunities at very, very reasonable prices again. So that unlocking 2.0 is something that we anticipate to happen. Obviously, it has already started in last 1 year. Just the digital transformation part of the portfolio has delivered phenomenal returns for the portfolio, but that will continue to happen as the market continues to reprice it, and it's a very, very long decadal growth opportunity. So in some of the best managed companies, cash rich, you continue to see buybacks happening in this space. That's an indicative of mispricing. That's an indicative of cash rich and strong balance sheets, zero debt, high margins, high profitability. So it's a very, very amazing part of the market that we really like. Defense was one thing that we identified way, way ahead of the market, and it's a very, very unique opportunity. The growth vectors are very strong. Defense budgets being marked to the GDP, typically as a percentage of the GDP. And while the GDP continues to grow at double digit, the defense budgets continue to grow at double digit. Other than that, there's a whole new focus on the export market, right? So we have defense attaches to manage, to give a single window clearance to or single window available to companies or countries who are interested in buying defense systems, defense equipments from us. And there's a phenomenal work that has been done by the ministry on this side. And so that is, indigenization has been undertaken in past many years. 3 years back, while we were acquiring around 50-55% defense equipments indigenously, now that number has gone to 75%, right? And the plan is to take it to 90%. So that's another growth vector for the domestic companies. So their growth comes from as the defense budget grows at double digit, the export opportunity that comes along, and the indigenization that continues to happen. So all these things are strong, and it is evident in the order books for these companies, if you've seen. And obviously, you have to have a continuous oversight in sense of which company is becoming overvalued, how the market is unlocking a potential, and how you have to make changes in the portfolio. That is a continuous thing that happens in the portfolio. So this is another growth factor that we are seeing. Power is a fantastic growth factor again. The per capita consumption for power, as our per capita income goes from $2,500 to something like $12,000, it is expected to go high at least 5 to 6 times. And that's one estimate. But even the basic government estimate gives something like a double-digit CAGR for the number of units that are being consumed from between now and, let's say, 2030. So that is one. Other than that, there are multiple, it's a very dynamic space, the energy and the clean tech and renewable space that all comes around in the power growth factor. So there's a lot of things that are happening on the EV side, right? Now, a very interesting way to play EV is through power. That's what we believe. Obviously, you try to there are very few EV pure play names, and they're all overvalued because everyone understands the excitement around it. But this is something that our estimate tells us that around 20-25% of additional power will be required just for the EV infrastructure in by 2030. So that is one additional growth vector other than the normal consumption and the extra consumption because of the export orientation that we are working with. The third part is the electrification, right? So railway has already electrified. Now they are going to go and take 50% of the or 45 to 50% of the market share of the freight side, which all be running on electricity. And so whatever is being transported using roads which runs on diesel will be running on electricity. So that's an additional growth on the power consumption. And you can look at these companies planned capex work in progress. So everyone is working on something like doubling, whatever they have current investment corpus in terms of the operating assets, equal or more is being put in work in progress stage. Right? The capacity expansion is going to happen in a big way, which will play out in terms of higher ROE, higher earnings, and the re-rating followed by that. So this is again a very, very interesting space to look at. Capital enablers, this includes financial institutions. While a lot of infrastructure spending is happening, all that goes through a very, very, I would say, it's still a very monopolized sector in terms of banks and financial institutions. Most of this, so we estimate that 200 lakh crore of fresh investments and nearly 100 lakh crore of brownfield investments on the extra capacity building that the existing industry that is going to do is something kind of a potential for the next 10 years or so. Okay? And now this all will flow through the largest private sector and public sector banks, the specialized NBFCs, whether they are handling, let's say, power or urban development or railways and so on. So this is the growth for this, these institutions is kind of a given, right? All of these or many of these have come out of a bad NPA cycle. The books have got cleaned up. Their margins, ROEs have improved significantly. And the credit growth is growing nearly 20% in the last 2 years. So that's an indication that things are extremely good in this side. And obviously, to support all that infrastructure or, logistics and everything that I talked about, you need a lot of financing, whether it is equity or debt. So you need all these exchanges, you need rating agencies, you need NBFCs, you need banks to support that. And that's where the growth that will come through. So this, and you're getting this again, historically, if you compare at very, very attractive valuations, very, very attractive space, to be. And this is what, you get an exposure to if you use the scientific investing framework to identify this. EV, again, a great opportunity. We've talked about it. Everyone broadly knows about it, but then power is one way to play around that. Battery technology is another that we have seen. And hydrogen is something, again, that has emerged. A lot of investment that has started. Government itself expects to, do something like a 8 lakh crore investments in the next 7-8 years. And that's where the opportunity is emerging, and we remain bullish on this space. So that's kind of a rather quick, because there's a lot to be talked about each of these growth sectors. But then I just wanted to give you a very, very short overview. Again, I will not get too much into the product description. This is standard, let me just go to the prime equity. The prime equity is the one that that selects companies from the top 1,000 listed companies in India and runs it through the scientific investing framework, reducing, or mitigating, eliminating companies which we believe are risky, and identifying and optimizing on the different growth vectors that I just talked about. So this has been running, I think, for more than 5 years now. I think these details can be shared with whoever is interested by Deepak or that product team. But I want to just highlight on two things here. One, that the strategy has been ranked number 5 with 5 stars among the 66 or 67 strategies which fall under the multi-cap space. And there are the 6 or 7 strategies that have been ranked with 5 stars. And the framework is quite interesting. Like, if you have not looked at this study by PMS Bazaar, which they have done in association with CRISIL, the best part that I found here is they have a nearly 50% allocation to risk parameters and 50% allocation to the return parameters. So portfolio diversification, portfolio volatility, portfolio diversification at stock level and the sector level, and then the return profile on consistent basis is something that has been put together. And this is where what gets captured in what I've been trying to tell, that the investment philosophy is the genesis of any kind of a performance that comes around. And this has been proven in this particular ranking exercise as well. Just for the the benefit of the clients and benefit of how the PMS market is currently stacked up. Again, the data source is PMS Bazaar study only, and what we have looked at, we have put here is the CAGR numbers for 1 year, 2 year, 3 year, 5 year, whatever the data points, and we have just compared ourselves with the most popular schemes, most popular by AUM. So the largest schemes in terms of AUM, what is the delivery in the last 3 year, 5 year period, and what has been delivered. And so we have done exceptionally well ahead of the market, because that's our first benchmark. But obviously peers is something I want to look at, and it is extremely important because it's not about the numbers, right? It's about that if inherently there is a risk in your investment philosophy, then sooner or later that is something going to play out. And that is what we need to be aware of. And that's where a lot of emphasis on, enhancing safety, enhancing, growth. So, which is long-term in nature, not just that I found 3 stock and 5 stock and which went up and that's why. So while this performance has been delivered, this has been delivered with a 30-35 stock portfolio, which had been an equal weighted portfolio, right? So it's something that not that it was a punt on few sector or few stocks that helped us deliver this. We delivered this with a very, very safer, like raising the bar ourselves for being safety, for focusing on the safety first, and then worrying about the, so the essence of, Ashwini Mehta insight has played out on this end. So I'll just end here. These are the disclaimers, extremely important for all of us. All the details are available with the team, but I'll just take a pause here to see if there are any questions, and then I can spend few minutes on the basket offering also that come from the Ashwini Mehta group, as Karan bhai said. So I'll just take a pause here.
Thank you, Ashwini, for
hello.
Yeah.
Yeah, hello, good evening. Yeah, that's very nice presenters, very Christian. What I feel like, can you just continue with your basket of products also? So after that on, we can have the broader question and answers if
Okay.
our conduct
Sure.
is equal to their proposition.
Perfect. Yeah. So again, continuing with the investment philosophy, we have a strong belief that these investment strategies which are available to high ticket size individuals, like which are delivered through AIF or PMS structures, should be made available to clients which have a lower ticket size or lower investment corpus. Through that orientation, we have brought in these portfolios. Now, what we have done is like the flexi cap portfolio. is something you get 6-7 different growth factors that you get exposure to, right? But when I split them up into smaller portfolios, right, then you get the same exposure of, let's say, a high growth sector like a railway or a defense or a capital enabler, but then that gets enabled through a basket structure at a much lower ticket size, right? Something like a 50,000 or a 1 lakh kind of a ticket size, it is enabled at that level, right? So that is a core concept. What we do here is we have two set of offerings. One is what we call as core offerings, which are typical, your large cap, mid cap, small cap kind of portfolios, which again you can take exposure at 25,000, 15,000, and so on. Plus, there is a set of thematic portfolios, which includes like digital transformation, railways, or defense, and so on. Now, as an advisor, it gives us flexibility to do a broader asset allocation. Like say, even if someone is coming at 50 lakhs and he doesn't want to take exposure to one single product, he feels like diversification is a natural principle, and I should go and diversify. So you can build a portfolio. You can, depending on his risk profile and how he is looking at like whatever requirements he has, you can do 50, 60, 70% of allocations to the core investment strategies, and you can do remaining allocations to thematic to boost the return profile, right? Obviously, it comes with a higher risk because now you are exposed to one single sector or one single growth sector. So that's why we will always recommend that you have, let's say 5%, 5 to 10% of your equity investments into one of these growth sectors, and you have remaining into the core strategies. So that's the idea, to remain diversified but still boost your return profile. And you build through a SIP kind of a structure, so that no one is asking you to be a 50 lakh client on day one. You start with 10 lakh rupees, you start with 5 lakh rupees, you build through a SIP, just like you do, let's say, on a mutual fund space. But then here you can do the same, a high alpha, potentially high alpha strategies, but and increase your profile for the overall portfolio that you have. So we have these strategies available at 10,000, 15,000, and so on, which gives you exposure to, let's say, railway infrastructure. So it's the same story, the same similar companies. Obviously, because of the lower ticket size constraints, at times you might have to drop certain companies which have a very high price, not the multiple, but the actual absolute price itself is, if it is 5,000-7,000, then it may not fit into the portfolio, but it may still be the part of the PMS portfolio, right? So those restrictions might be there, but nevertheless, it gives you the same exposure or similar exposure, and you are still oriented to a alpha generating potentially or a higher return potential kind of a investment offering. So there is a good 10 plus offerings which are there on the iBasket platform, and you can look at their past performances. You can look at their fundamentals, current fundamentals, because whatever you are investing is investing for the future from today. Right? So we always believe that we never want to rely on the past losses. We want to say that today, for example, I just take one quick example: our multi-cap, flexi-cap strategy itself. Now, today, when it has delivered a strong return in the last 5 years or whatever time horizon you want to see, today its fundamentals are still better than the market, where the market has a ROE of, let's say, 14-15%, is a slightly 15-16% kind of ROE with low debt, cash rich actually. So we have a cash sitting on the, so at a portfolio level, like those 35 companies, if I just consider it as a one single conglomerate and build the balance sheet, then you will realize that the conglomerate has a higher ROE, it has a cash rich balance sheet, and it has all the margins profile which are better than the broader market. Yet it is cheaper than the market. So while the market is at 24, 25 PE, our portfolio is at 14, 15 PE. So while it is compounding at a strong rate, there is a potential to do re-rating. Right? That's why we benefited from this. Like 1 year back, if there's a crazy return, a lot of re-rating has happened in my portfolio. 1 year back, our PE was something like a 9. Now it is at 40, but it's still significantly behind, right? Then the true multiple that this kind of a portfolio should have. And that's where we are generating, that's how our orientation to generate excess returns. Right? So that's a very quick, all basket related, which are the offerings that are there and what are the minimum ticket size, what is the kind of, still, I would always say that, whether you're coming in a basket or a PMS, for us, 3 to 5 years is a minimum horizon. Even if you're putting into a smaller ticket size or a thematic opportunity. If the thematic opportunities evolves and gets played out and it is overvalued, then we are the first ones will go and tell you that this is the time to move funds from this thematic to some other thematic or growth sector. But till that time, you should come with a longer horizon and recommend only for like a 3-year plus kind of a horizon.
Any other questions?
Thanks, Ashwini ji, for the wonderful session. We can open with the FAQs. If you have any questions, we'll definitely, Ashwini sir will be able to answer you.
Yeah, good evening to this, our fraternity and the Ashwini sir. This is Pankaj Parmar here. Can I proceed?
Hello.
Yeah,
Yes.
can I proceed? Acha.
Please.
Hello. Acha,
Yes, please
this
go
very
ahead.
nice, what is a very juicy presentation you made, very tempting one. Everybody want to transfer all this portfolio to hot buckets. Rather, that is what it seems like at the moment. Yeah, apart from that,
Right.
what I feel like, what you are missing about this one, SME and micro segment. So, do you feel like there is still scope or there is still steam left in that, or it is yet to come up?
So SME micro specifically kept out of our universe of to identify companies from. That's why we have kept at top 1,000 companies, where typically the market cap cutoff is around 1,000 crore only, depending on where the market, what market size is, market level is. Sometimes you can also find 800, 900 crore market cap companies. Sometimes it is 1,100, right? But the point here is that particular segment, where when you talk about, let's say, 50 crore to 500 crore companies, that is a different kind of an investment. Need a different kind of an investment lens to go through that. And this is where, when I have amazing opportunities in the larger cap itself, right, or in the top 1,000 companies itself, then that is something not the focus area for us, right? So obviously there are opportunities. I'm not denying. I'm saying that India is going to be 30 trillion or 50 trillion. Obviously, the emerging, or that emergence of smaller companies will be there, and they are going to create that. We will have a S&P 1500 by the time we reach there. So absolutely opportunities are there, but you need a different lens. The corporate governance is slightly different. Reliability on numbers is slightly different compared to when you are looking at the top 1,000. Top 1,000, when you're saying these are all national level companies, practically they're leaders in their space, right? So the corporate governance is much different. You have a lot of reliability on the numbers that you are looking at, and that's why we stick to this side. And that is not the offering that we are rolling out as of now.
Oh, no. Further to that, I do fully agree with you and endorse with your view. But my point is different. Now the corporate governance, now every SME units or whatever the manufacturing units, they are more focusing on this, about the strictness about all the rules and regulations. Now there are the earlier rules and regulations. They were permitting, like the loops, or you check best use of that one and get out of that. Other next generation is more strictly about the sticking to the rules and regulations. So I think corporate governments would duly taken care of by this upcoming or the existing SME or all the small cap. That is what I personally feel like. So
I totally agree. Yeah. So, but still, these smaller the companies, the risk of still high, because one single order can make or break. One single vendor can make or break that company. And you need a different, like for us, we will have a 50 stock portfolio if I were to do a micro cap, right?
Okay.
So the kind of bandwidth that is required now to look at the next 1,500 companies and identify 50 stocks, it's a completely different thing, which we believe that we are not want to specialize on that front at this point in time. So that's where
Thank you. Appreciate that. Thank you and appreciate that. Also, I want to get in touch with you or anybody that PR or any contact persons is there. So can you just put out a name?
Yes.
Huh? Or anybody?
Yes, I think.
Yeah.
Please get
Yeah,
in
Vijay,
my
Yeah,
number.
I'm from
We'll
Ashish
get,
Sir. I will be getting in touch with you, sir.
this is my Pankaj Parmar, 940-860-2806. That is my number.
Okay, sir. Yeah, I will definitely get back to you.
Thank you. Thank you, sir.
Thank you. Thank you.
Vijay, I think there was question in chat box. One question in chat box. Can you access that?
Yeah, एक minute. Yazdi sir wanted to know any X capital destroyer which we have identified.
Okay. Yes. See, typically wherever there's been a large, debt, that is one clear example. And we don't have to go very far. Even the Future Group, the Reliance Group, they crumbled because of the debt they had taken, which they could not service when the economy actually went south. So those are the examples where debt has resulted in high debt has resulted. Airline business is another such thing. So these are the examples that you have seen, because they're not able to service their debt, and then shareholders lose everything, and whatever the debt holders can kind of salvage, they salvage.
Any more questions?
About this hurdle rate, do you have any system on that one? Do you put hurdle rates and then what is the return is accordingly calculated? Do you have something like that system, or it is a flat net return that would be passing
I
on
think
to
we
the?
have both. We have both fee structures. We have a flat fee structure as well as a flat, some and a performance fee beyond a hurdle rate. So that detail again, Vijay will share with you.
Again, we'll on the fee structure. We'll definitely speak one-to-one on that.
Please, sir. Thank you.
Yeah, sure.
So any more questions are there?
Any more questions, sir?
Sir, and now we have to clear the PMS this thing also for giving PMS to clients, or ARN will be sufficing, because previously ARN was sufficing.
It's more of a compliance query, but I think if Vijay has a clear idea, then he can. Otherwise, we'll definitely come back to you on this. I'm frankly not aware about this requirement.
Yeah, actually, it's a. Can I answer all the query?
Yes, please go ahead,
Yeah.
sir.
Actually, yeah, this is a new mandate from SEBI to get the PMS certification as well, to get the distribution income in PMS.
Okay.
Earlier it was not, but now it's a mandate.
Okay. Right. Thank you.
Obviously, you can look at the basket, high baskets till, let's say, if
Yeah,
any time
basket
is going in terms of getting that compliance done.
Great. Any more questions we have? I think no more questions are there.
Any more questions?
So I think we can end the session today.
Okay, just want to add few things. For iBasket, you don't need to have any kind of a certification. It's like if you have a normal distribution license, means as a franchisee or something, you can sell that product. So you don't need ARN as well as PMS certification to sell that product.
Okay, then thank you everyone for patiently listening, and it was really a pleasure interacting with all of you.
Thank you, sir.
Thank you.
Thank you.
Team.
Thank
Thank
you.
you for the session.